Hello, this is Dr. Janice Seto, and I'm your instructor for this course in accounting. It's grade 12. And so here is our second PowerPoint, and we're going to go and take off from what we learned before, which we looked at some ethics, and we looked at some basic terms. So let's go and analyze some business transactions. This is a 15-minute video on screencast. So our first objective is to just further talk about some of these terms. We looked at liability last time, and so we'll look at asset and owner's equities account. And as I had mentioned before, this is going to be, well, accounting is basically all about beer. So let's go and take a look at what we have. So as I said, the business has a value and it's based on what you own, or what the business owns. And ownership basically is the term property. I'm going to be using Starbucks. We started talking about Starbucks and what it owns. The one down the road, which is 24 hours. As you can see, it has cash, coffee beans, and lots of equipment. And it's prepaid some of the rent in advance, so that has value. It's something that you own. And again, that's something that's quite standard with most businesses. And now I've added here accounts receivable. Now what's accounts receivable? You're waiting for somebody to pay you, and that's worth something. So Starbucks, they may have had an order from a business that says, we want to have 100 scones, and so they'll deliver it, and they say, we'll pay you later. So what's in effect happened is a receivable has been created. It's an account receivable. So basically this has value. We're just waiting for them to pay Starbucks. So assets are what we own, and equity is basically ownership in a business. And you can see from that, assets, basically what the company owns, should equal the value of the business, the equity. Now, however, it's not as simple as assets equals equity, because everybody has bills to pay. In other words, what you owe. Now, so what you have to pay is called a liability. And some of the examples of the liabilities from Starbucks is, well, if they sold Starbucks the beans, Starbucks pays them. So they've got an accounts payable. So that's a liability for the beans. Another liability is labor or payroll. Somebody works, you owe them money for their hard work. The other thing is, when you're making coffee at Starbucks, you have to have energy and you have to have water. So these are the utilities, which is also a liability. And of course, taxes. There's business taxes, property taxes. There's lots of ways in which the government gets money. Well, let's take a look again. So basically, what we have here is the value of the business should equal what you own, which is the assets, minus what you owe, which are the liabilities. And so I've got this definition right here. So value of the business equals what you own versus what you owe. So the financial interest is which is up here, is the liabilities plus your owner's equity. So let's very quickly go into a business, and we'll look at somebody who's starting up a business. That's what we're often asked to do here since jobs are not something that can be guaranteed. They're asked to start a business. So we're going to look at John Arrow, who's a CGA. So he's certified general accountant, and this is a Canadian example, who has Virginia Rishi. She's the office manager. So while he concentrates on doing the accounting, she runs the business. Okay, so here it is. So we're going to look at how a business, a startup, obeys the accounting equation. Okay, so the first thing it does is John's got savings. He's got 40,000. So that's about ringgit, 120,000 ringgit. And he's been saving up his money for a while. Says, great, I'm going to make sure that I seed the money, I fund this business, I invest 40,000 and of my value in the form of cash. Remember, cash is very, very liquid. I'm going to put that in the bank. So then what you see is the value of the business is 40,000. That's his equity, and the business itself has 40,000 in the asset column or as property. So what you see here is the property is the cash, the financial interest is John, and it's his capital. What do we have now? He's invested 40 in cash, and therefore his equity is 40. So it balances 40 plus 40. Next thing is John says, I've got to rent a place. So you've got to have an office space. If you rent an office space, then the landlords or property managers usually say, please put in some extra money. So if you want to have this for 8 months, then maybe you should pay some of it in advance because you're a new person. We don't know how much likelihood you'd stay in business. So maybe we'll give you cheap rent. You should pay it in advance. All right. So therefore, he's prepaid 20,000. So what's happened is he used the money in the bank account that's owned by the business. So let's take a look. So now we saw before 40 equals 40. 40 financial interest in the capital and 40 in the asset under cash. But with this transaction, he's taken money from cash and it's now in the form of prepaid rent. So to make sure it balances, take 40, subtract the 20, then you have the 20 here plus 40, and basically it balances 40 and 40. Third transaction is now he's funded it with 40,000. He's got a place rented out, and now he's going to have get some equipment. So what he's done is he's buying equipment, 10,000, maybe printer, maybe cables, maybe a laptop. So he's got to get set up. You're an accountant, you have some expenses. So basically he's purchased it. He's paid it out in cash. So now let's take a look at the value of the business. So before we had there was 40,000, and then he used 20,000 to pay rent. 20,000 left. And there's 40. This he's done. He's taken 10 in cash and bought equipment. So in the value is still 40,000. 40 and 40. Now he's decided he's got to buy more equipment. This time he's not going to pay for it in cash, because you notice he's low in cash. He's only got 10,000 left. So now he's going to go and buy equipment, but instead of paying cash, we're going to put it on credit. So went to this place called Oregon and Corporate. He says, okay, we'll sell you this, and you could pay it back later on. So it's 5,000. Now here, I would like to note that he now owes 5,000 to Oregon. Now let's take a look at this equation. So before, he had 10,000 in cash, 20,000 in asset and prepaid rent, and then equipment worth 10,000. And then so the value of the business is ownership. It's worth 40. Now, he's purchased more equipment for 5,000. And because he hasn't paid for it yet, and he needs to pay it, this is what we call the accounts payable. And so he's generated a liability of 5,000. Now look, if you could see 5 plus 40, the value of the business now is 45, because not only has he got his capital, he's also purchased equipment. And there you are, 45. Now he wants to buy supplies. Now what's the difference between supplies and equipment? Well, equipment is like computers, desks. These are chairs, which have a life beyond 1 year. Supplies, on the other hand, you expect to use up within a year. Toilet paper, regular paper, pens. You purchase, and you know that you're probably going to have to replace it. So now what he's done is purchase supplies, and it's cost 1,000, and he's used cash for it. Notice the cash is going down really, really quickly. It was 10,000. Now spend another 1,000, and now he's only got 9,000 in cash. So take a look at what we have right now. Again, 45 and 45 balance. He's purchased supplies, so now it's increased the value by 1,000. But actually, because he used cash to pay for it, these equal out. So now it's 45 here and 45 here. So now what we see is the next transaction is he's decided to pay $1,000 to Oregon. So he owed originally for equipment worth $5,000. He created a liability. He owed $5,000, but now he says, "I'm going to pay $1,000." So what that does, it reduces your accounts payable. So by $1,000. So instead of owing Oregon $5,000, now you owe just $4,000. Let's see. All right. So here we are. The previous balance, 45 and 45. But because he's used the cash, he's reduced this side, his property, by 1,000. So the value's been reduced from 45 to 44,000. And in this side, because the debt, what he owed to Oregon, is no longer 5,000, is now just 4,000 because he paid 1,000. You can see now that the value of the property is 4,000 or 44,000, and also 44,000 here. So here's our accounting equation. The accounting equation is basically the property equals the financial interest. If you break it down, you've got beer. Assets equals liability plus owner's equity. A-L-E. Ale. Or assets equals liabilities and equity. Beer. Okay? And so what we've done is we've seen that the assets of a company or a business, there's many. One is cash, one supplies, prepaid rent, and equipment. And then on this side, accounts payables and the capital, which is John Air. So what I'd like you to do is we're going to get our start in preparing our first financial statement. And so we're going to create a balance sheet. That's a very important financial statement. So let's take the information here. You've got 8,000 in cash, 1,000 in supplies, 20,000 in prepaid rent, equipment 15,000, and accounts payable 4,000, which is the liability, and for J. Arrow Capital, which is the owner's equity. So to create a balance sheet, we use a special formula. Well, special format, standard. But first, you have at the top of this, you have who is the entity, and it's Arrow Employment Services, which is John Arrow, and that's the business created. Now you have to say which financial statement is this, and this is the balance sheet. So the business first, then the balance sheet, and then the date. When did this happen? So it says November 30th, 2000 X5. Well, why don't we just put this one for July 31st, 2015. So now let's put all these different items where they belong. The assets, so you put assets and you underline it. Then you flush left the different assets. And you put the assets in a special order. It's called order of liquidity. What you can convert into liquid value first. Cash, easy. Supplies, then prepaid rent, then the equipment, then total assets, and then you put an underline, you total this up, and you double underline that. You do the same thing for liabilities and owner's equity. Liabilities first and underline it, put the liability and the amount, then the owner's equity and the amount. Now the double underline is liabilities plus owner's equity. Here, assets, liabilities plus owner's equity. And these two have to equal each other. So I'd like you to try it yourself. Please take on your textbook, which is page 33. It's number 9 of the text, which is by Harrison Horngreen. I'd like to draw a balance sheet using the format above and in the previous slide. Okay, so thank you very much. That's our lesson, introducing you to analyzing financial transactions. And good luck. We'll see you in class. Bye.